Welcome to This Explainer. You know, if you've ever looked at a massive corporation and wondered how a single, simple transaction, like, say, buying a loaf of bread, eventually translates into actual wealth for a shareholder, well, you are in the exact right place. Today, we're going to literally follow the money. We are taking a journey through the entire life cycle of a business, and we'll use a bustling wholesale bakery as our working metaphor. Together, we're going to completely demystify accounting. We'll start right at the micro level, with basic sales on the shop floor, and we'll track that exact value all the way up to the macro level of corporate equity. Okay, let's dive into this. Our visual roadmap today is broken into 6 clear steps. 1, the double entry foundation. 2, navigating sales tax. 3, the deal with discounts. 4, controlling the cash. 5, the sole trader. And 6, the limited company. Let's kick things right off with Section 1, the double entry foundation. So let's pose a really fundamental question here. How does a business actually record a sale? Imagine our wholesale bakery just delivered a massive, amazing-smelling order of fresh sourdough to a local cafe. But they did it on credit. They haven't been paid actual cash yet. So, how does that physical, real-world event become hard data in the books?
Well, it happens through the beautiful symmetry of double-entry bookkeeping. The absolutely crucial insight to grasp here is that every single financial action has an equal and opposite reaction in the ledgers. Think of it exactly like a scale. On one side, if our bakery buys 1,000 rupees of flour on credit, we debit our purchases to show the expense going up. But to keep the whole thing balanced, we have to credit payables, because our liability, the money we owe that supplier, also just went up. Now, on the flip side, when we sell that sourdough for $1,500 on credit, we debit receivables because our asset, what the cafe owes us, goes up, and we credit sales because our income has increased. There are literally 2 sides to every single coin in accounting.
But what happens when things don't go exactly as planned, right? What if we receive a batch of bad flour and we need to send 200 rupees worth back to the supplier? In accounting, you definitely don't just grab an eraser and delete the old record. No way. That is practically an invitation for fraud. Instead, you handle it by sequentially reversing the original transaction. You debit the payables account, which drops your liability because you don't owe them that money anymore, and you credit the purchase returns account, which effectively reduces your overall purchase expenses. It creates this perfect, totally auditable mirror image. Moving right along to Section 2, navigating sales tax. Enter the government. Most countries use some kind of consumption tax, like VAT or GST. Honestly, the absolute best way to understand this is to picture the business as simply holding a giant bucket for the government. You have your output tax, that's the tax you charge your customers when you make a sale. Crucially, this is not your money. It goes straight into the bucket as a liability you owe the tax authority. Then you have your input tax, which is the tax you paid to your own suppliers. And you actually get to reach in and pull this back out of the bucket as a recoverable asset. Come tax time, you just pay the net difference. You, my friend, are merely the unpaid collection agent. Let's see how this bucket mechanism works in practice. If our bakery makes a 1,000 rupee sale and there's a 20% sales tax, we don't just record $1,000. The customer actually owes us 1,200 total, so our receivables get a debit of 1,200. But over on the credit side, we split it up. We record the 1,000 in actual keep the lights on business revenue under sales, and that extra 200, we put that straight into a sales tax control account. That 200 is totally fenced off. It's an active liability sitting right there in the ledger, just waiting to be paid out to the government.
All right, Section 3, the deal with discounts.
Now, businesses give out discounts all the time, but accounting treats them very differently depending on the intention behind them. First up, we have trade discounts. These are simple, straightforward reductions in the list price just for buying in bulk. From an accounting perspective, these are practically invisible. If a 100 rupee bag of sugar has a 10% trade discount, you literally just record the transaction at 90. Super simple. But settlement discounts, totally different story. These are offered to encourage early payment, and under modern accounting rules like IFRS 15, they actually require the business to make a psychological bet on customer behavior right at the point of sale. Now, what's really interesting about this slide is how that psychological bet actually plays out mathematically. Imagine a 1,000 rupee sale, but you offer a 2% discount if the customer pays within 14 days. Under IFRS 15's net method, if you actually expect them to take the discount, you don't record 1,000 in revenue. You immediately record 980. You recognize revenue at the amount you realistically expect to earn. But wait, what if they miss the deadline and end up paying the full 1,000 later? Well, you just record that extra 20 as additional finance income down the road. It's a really clever rule designed to force the accounting to match economic reality on day one, rather than falsely inflating those early numbers. Okay, let's zoom back in from global accounting standards to the day-to-day reality of running our bakery. Here is Section 4, Controlling the Cash. We have to talk about petty cash. I know, it sounds incredibly boring, tracking a few loose rupees for emergency milk or a desperate taxi fare across town. But make absolutely no mistake, petty cash records are your frontline defense. They provide total accountability. They prevent fraud by requiring a receipt for every single disbursement, so no more mysterious missing 20s. They ensure financial accuracy so your profits aren't falsely inflated, and they create a completely bulletproof audit trail. Minor, uncontrolled expenses will leak major profits over time if you aren't careful.
So how do we actually maintain this control? Well, it's a very strict, specific procedure. Let's say we keep a 100 rupee petty cash float in a little lockbox. Step 1, you check the physical box at the end of the week and you see you only have 10 rupees left in coins. Step 2, you tally up the physical paper vouchers left in the box by your staff. You find 30 spent for postage, 40 for emergency stationery, and 20 for that taxi. Boom, that perfectly totals 90 rupees. Step 3, you request a replenishment check from the main bank account for exactly 90 rupees to bring the physical cash float right back up to its original 100.
And here is where the real magic of the whole system happens. That final replenishment entry is a single credit to the main bank ledger for 90 rupees with corresponding debits to all those various expense accounts. This one sweeping entry finally links all those tiny, seemingly insignificant, chaotic expenses back into the grand, orderly financial control system of the business. The loop is officially closed.
All right, Section 5, the sole trader. Let's start with the absolute simplest legal structure out there, the sole trader. Here, there's basically no legal difference between the owner and the business itself. And this brilliantly illustrates how all the profits, all the investments, they all boil down to a simple mathematical statement of what the sole trader owns. The owner starts the year with 10,000 in capital. They inject another 5,000 of their own savings. The bakery does great and makes 3,000 in net profit, but the owner takes out 2,000 to live on. That leaves an ending capital balance of $16,000. That $16,000 is exactly what the business effectively owes the owner.
Now, I want to vigorously clarify a massive point of confusion here, the owner's draw. When a sole trader takes 2,000 rupees out of the till to pay their personal rent or to buy groceries, it is absolutely 100% not a business expense. You cannot deduct it to lower your business profit and save on taxes. It is simply a withdrawal of equity. It hits the balance sheet directly, reducing the owner's total stake in the company, and it bypasses the profit and loss statement completely.
Moving to our final section, Section 6, the limited company.
So what happens when the bakery gets huge? When we completely outgrow the simple owner-operator model and transition to a formal corporate structure? In a limited company, the business is a distinct legal entity, totally separate from the people who own it. Because of this legal wall, ownership is splintered into formal components. You have share capital, which represents the nominal or face value of the shares initially issued. You have the share premium account, tracking any extra cash eager investors paid above that face value. And finally, you have retained earnings. Think of this as the massive pool of accumulated profits the company has kept over the years to fuel growth instead of paying it out to owners as dividends.
To really wrap your head around corporate equity, you have to understand how companies actually create new shares. Compare these two methods. First, a rights issue. This goes out to existing shareholders, asking them to buy more shares at a discount. This injects real, fresh cash directly into the business. But a bonus issue, also called a scrip issue, is fascinating. The company just gives out free shares to existing owners. Notice that absolutely no new cash enters the business here. It is a pure accounting illusion. It's just a paper transfer moving value from the retained earnings reserve over to the share capital account. The total pie stays the exact same size, it's just sliced into more pieces.
Which brings us to a really provocative question to leave you with. Ultimately, who truly owns the wealth your business creates? We followed the breadcrumbs today from a single sourdough sale, we navigated the taxes, managed the petty cash, and watched it all aggregate into equity. Whether you are a sole trader taking a personal draw to pay your mortgage or a shareholder in a limited company waiting on a dividend from retained earnings, understanding these accounting mechanics isn't just about passing some test. It is absolutely the key to controlling your financial destiny. Keep learning, keep digging into the numbers, and we'll see you in the next explainer.